In this video, let's talk about put options. Now, if you remember in the previous video, there's always a buyer and there's always a seller. So let's look at a put option from the buyer's perspective. The put option gives the buyer of the put the right, but not obligation, to sell 100 shares of a certain stock at a certain price on or before the expiration. Now, if you remember the call option definition, they're actually very similar. So I'm actually going to put up call buyer here. They also have the right but not obligation to buy 100 shares at a certain price on or before an expiration. So they're actually the exact same definition between the call option and the put option, except for this one word. The put option gives you the right to sell the stock. The call option gives you the right to buy the stock. All right, so what is a good way to know the difference between a call option and a put option? Everyone do this with your hand. Pretend it's a phone. I know you look silly, but I'm doing it too. You call up your best friend. After the conversation, you put down the phone. You call up, you put down. Call up, put down. So what does this mean? It means if you think the stock is gonna go up, you would call up your friend, as in you would buy a call option. Now, if you think the stock's gonna go down, you put down the phone, as in you would buy a put option. So call up, put down. Now, what I'm about to say is so important, so make sure you pay attention to this part. Now, just because you think a stock's gonna go up, it does not mean you should actually buy a call option. And just because you think the stock's gonna go down, it does not mean you should actually buy a put option. The reason why I'm using this example is so you can keep the definitions of the call option versus put option straight in your mind, so it makes this learning process a lot easier. Again, it's not actual directions on what you should do. This is a good way to remember the difference between a call option and a put option from the buyer's perspective. Remember, there's always the buyer and there's a seller. So this is from the buyer's perspective. Call up, put down. So let's jump back into it. So now that we know the difference between a call option and a put option and how they're the exact same thing except this one word, put option is sell and call option is buy, let's look at the put option from the seller's perspective. So we got the put seller here. So if the put buyer has a right, but not the obligation, that means the put seller is actually obligated to buy 100 shares and it's the same at a certain price and it's at the expiration. Remember, these two are on the exact opposite sides of the trades. So the put buyer bought the contract from the person who wrote the contract, the put seller. So let's look at an example. Let's say a stock right now is trading at $100 and someone believes that the stock's going to go down in value. So they buy a put option with a strike price of 95. So we're going to put this from the put buyer's perspective. So if the stock goes below $95, that means the put buyer has the right to sell their stock at $95. So stock could be trading at $90 because the put buyer bought a put option at $95 strike price. They can sell their stock at $95 even if it's trading at 90. Again, this is during a specific time period. So let's say the expiration date is in 30 days. So a lot can happen in 30 days, and that's why these options even have value, because no one knows with 100% certainty what's going to happen between now and 30 days. It means the stock can go down in value, or it can go up, or it could just stay flat, right? No one really knows what's going to happen, and that's why these options have value. Now, let's look at an example, assuming the stock's actually above $95. Well, that means this option contract is going to expire worthless. Remember, there's a 30-day time period, and I'm using 30 days arbitrarily here. In future videos, we're going to actually look at days to expiration, but we're going to use 30 days arbitrarily right here. So it will expire worthless. Why does it expire worthless? It's because what does the put option give you the right to do? Pause the video right here, try to answer it, and then play to see if you're right. Well, the put option, if you bought it, gives you the right to sell the stock. If the put option gives you the right to sell the stock at $95, well, this means why would you sell it at $95 if the stock's trading above? Let's say it's trading at $98 at expiration. There's no point of you selling it at $3 less when you could sell it in the open market for $98. And because the contract expired at the 30-day mark, this whole contract just expires worthless. However, if the stock is trading below $95, because it gave you the right to sell it at 95, it makes sense of exercising your option, selling at 95. All right, so that is from the put buyer's perspective. Let's look at the put seller. So remember, these two are on the exact opposite sides of the trade. So important to know. There's always a buyer and there's always a seller, or else there would not be a market. So from the put seller's perspective, again, the stock's trading at $100. The strike price that they sold the put option was at 95. And let's say the stock's trading at 90. And I just noticed this. I don't know why it says 100, but it should be 90, and it should have been 90 the entire time. So with the put seller, so because they sold the put option at $95, they collect a premium. So why did they get the premium? It's because they accepted the obligation of buying the stock at $95, right? So remember, the put buyer, they have the right to sell the stock. That means the put seller is obligated to buy the stock at $95. So to accept this obligation, they get to collect a premium. So a few things can happen here. The stock can go down in value, which in this case, they become obligated to buy the stock at $95 because they got paid a premium to accept the obligation. Or the stock can stay above $95, at which case they get to keep the entire premium because the option would have expired worthless. Remember this right here? It's because a put option buyer would not exercise their option to sell their stock at 95 if they could just sell it in the open market for 98 or whatever the price is at that time. So therefore, as a put seller, they get to keep the entire premium, and that's the goal of the put seller. They want to collect the premium and not get assigned. And that's why the put seller gets into these trades, because they want to collect the premium. Now let's look at a real world example of a put option. All right, well, this is my beautifully drawn car. There we go. In case, yeah, it's a car. Now think of cars, right? Every 6 months you pay your premium. That's you pay your premium. So if you don't crash your car, you just end up losing the premium, right? Like every 6 months you pay your premium. If you don't crash it, you just lose your premium and then you buy more insurance, right? That's what insurance is. However, if you do crash your car, then you have the right to sell your car to insurance company. This is what the put option buyer is actually doing. They are buying insurance on a stock. So if a stock does not go down in value and it goes up in value, or it kind of stays where it's at, they just end up losing that premium, as in there's no insurance claim. However, if the stock does go down in value, then they have the right to sell their stock to the insurance company because there is an insurance claim. So this is what the buyer for the put option is doing. Now the put seller is the insurance company. So they get to collect all this premium from the people buying insurance, right? However, if the stock does go down, they become obligated to buy the stock. So a great way to remember this is put buyer is insurance buyer, and then the put seller is the insurance company. I know that was a lot of information at you, but gave you those examples to just kind of help you keep the definition straight between a call option versus a put option, the buyer versus the seller, buying a house versus buying insurance, and just kind of how it kind of all interconnects. This is a very important part of the course, so make sure you go back, watch the videos, and if you need more clarity or if you have any questions, definitely feel free to reach out. I'd be more than happy to help. Well, I'll see you at the next video.